Hello everyone, and welcome back to the Gold TLDR. Folks, we are collectively witnessing another historic moment. Gold has actually hit the astronomical figure of $4,500. If you had told me 6 months ago that gold would reach $4,500, I'd have laughed and asked if you were still dreaming. But now, at this very moment, history has been rewritten, and do you know what the craziest part is? The most unbelievable part is that this record happened right after the US dropped super strong GDP data. Did you notice? Last night's market action was more of a roller coaster than a day at Six Flags. Once that US GDP data hit the wires last night, gold prices took a cliff dive plunge of $60. At that moment, many of you probably thought, it's over. Gold hit the 4,500 wall, the US economy is too strong, and the price is going to collapse. That army of stubborn bears was so hype, they were practically popping champagne, thinking they finally had proof that gold had peaked. The result? Was it a surprise? Was it unexpected? Gold took only a few hours to show us that gravity can't hold it down, pulling off a perfect V-shaped reversal. It didn't just claw back the losses, it kicked right through the 4,500 barrier along the way. In today's video, I'm going to break down the truth behind this bear massacre in the most direct way possible. Why did the seemingly invincible US economic data fail to stop gold's rally? Has the dollar's credibility really developed a structural crack? At this new $4,500 starting line, should we be chasing the rally or should we be afraid? I'm going to translate all this complex data into plain English for you. Before we dive into the heart of it, let's get the risk statement out of the way. All content in this video represents my personal views and does not constitute investment advice. Financial markets are unpredictable. When you make trading decisions, you must think for yourself, manage your risk, protect your wallet, and take full responsibility for your own profit and loss. Let's first review that moment last night that left countless traders both excited and on the edge of heartbreak. The U.S. Department of Commerce released the preliminary GDP for the third quarter of 2025. As soon as the numbers flashed, the entire market was stunned. 4.3%. Everyone, think about that. The market expected 3% at most, but the actual data blew past every expectation. It was even stronger than the 3.8% we saw in the second quarter. This marks the strongest growth record for the U.S. in nearly 2 years. Alongside GDP, the third quarter PCE inflation data hit 2.9%, showing that price pressures are still very much alive. In that instant, the market logic was blunt and simple. The economy is too hot, the Fed doesn't need to rush rate cuts, and they might stay higher for longer. As a result, the US dollar index shot up like it had a double espresso. And gold? It looked like it got hit by a sledgehammer, dropping straight from its highs and plunging nearly $60. If you were chasing longs at the top, that feeling was like being on the 101 observation deck when the glass suddenly shatters beneath your feet. It was pure desperation. Right on cue, the bear gurus jumped out saying, "See, the gold bubble is finally popping. 4,500 is the peak of a lifetime." The vibe was so heavy you'd think if you didn't sell your gold immediately, you'd be sleeping in the park by tomorrow. But here is the turning point. Note that if you only look at that 4.3% headline, you've already lost the game. Just as everyone feared gold would tank, the smart money calmed down to look at the fine print of the report. They realized that this 4.3% growth actually has a lot of fluff hidden inside. Reason 1. Consumer confidence is collectively collapsing. Even though the GDP headline is high, the Consumer Confidence Index released at the same time is in a steady freefall. Think about it. If people have no faith in the future, current spending is just pre-buying to beat inflation, or it's being forced by government stimulus. Once the government runs out of cash or credit cards hit their limits, this growth will vanish like a flash in the pan. Reason 2. The terrifying warning from durable goods orders. This point is absolutely critical. Last night's October durable goods orders actually tanked by 2.2% month on month. The market thought a 1.5% drop would be bad, but it came in at 2.2%. What are durable goods? We're talking big ticket items, fridges, cars, and planes, things meant to last. A drop here means companies and households are slashing their big spends. It's like a restaurant that has a crowd for cheap lunch, high GDP, but zero bookings for expensive banquets. This means the future engine of economic growth has completely dried up. Reason 3. When the data first hit, the dollar's reaction was way over the top. Once the market saw that the internal arteries of the U.S. economy weren't actually healthy, the dollar's rally ran out of steam. The gold bulls saw their opening and launched a counterattack while the bears were still busy celebrating. That is exactly why we witnessed that incredible V-shaped reversal. Gold didn't stay down for long before charging back to 4,450 and then smashing right through 4,500. Now that we've covered the data, we need to talk about something even scarier: political interference. This is the meat of today's video and the real reason why gold is going absolutely parabolic. We all know the dollar is the global reserve because the world believes the Fed is independent and won't just print money for the government. But that rule now looks like it's about to be tossed. Trump's recent comments are a direct assault on the nerves of global investors. He publicly doubled down last night, saying the next Fed chair must have the guts to cut rates. He's being incredibly blunt. If you don't listen to me and slash rates, don't even think about that job. The current frontrunner, White House advisor Kevin Hassett, claims she'll stay independent, but his recent words say otherwise. He said the U.S. rate cut pace is lagging far behind other global central banks. Translation: everyone else is printing money, so we need to hurry up and do the same. Folks, this is a very dangerous development. If Fed decisions are driven by White House politics instead of data, is the dollar still a safe haven? This strikes at the very heart of the dollar's credibility. When global central banks realize the dollar is a political tool that could shrink due to trade wars or sanctions, they have only one move: buy gold. This is exactly why central banks have been hoarding gold at record levels for 2 years. It's not just a love for gold, it's that they no longer trust the dollar 100%. The crack in the dollar's credibility is the most powerful engine driving this gold rally. So I want to ask you, if the Fed truly loses its independence, where do you think the dollar falls? Will gold really make a run for $5,000? Let's brainstorm in the comments. I want to hear your take. Now that we've got the macro view, let's look at the technical charts the pros are watching. I'm not going to bore you with complex formulas. I'll give it to you straight. The current US dollar index, DXY, is looking like a lost cause. On the massive monthly scale, the DXY actually broke a 3-year support level back in April. To a technical analyst, that means the party is over. It signals that the decade-long uptrend we've seen since 2011 is facing a structural collapse. Look at the short-term daily chart again. Since the November high, the dollar's downtrend channel has been textbook. It's showing zero signs of turning back. Even with that brief spike last night, it still closed as a massive red bar, rejection candle. Right now, the dollar has sliced through the key 98 level. If you ask me where the dollar goes next, my answer: it keeps heading south all the way down. Keep in mind, the dollar's rivals, the yen and euro, are either looking to hike rates or are holding steady. This shrinking interest rate gap will keep the pressure on the dollar. What does this mean for gold? It means even if gold doesn't rise on its own, a weaker dollar makes dollar-priced gold much more expensive. It's Buffett's classic rule: when the tide goes out, we finally see who has been swimming naked. All right, gold has now found its footing at $4,500. The question on everyone's mind: is it too late to buy? To be honest, when you're hitting fresh all-time highs like this, technical resistance is basically useless. There are no bag holders above us and no historical price levels to look at. It's like driving through a desert without a map. We go as far as the bulls want to take us. However, we can watch these psychological levels for the next move. Further upside targets: if the hype stays high, the next stops are $4,550 and even $4,600. Key support below. First, $4,500. This is now the most critical line in the sand. As long as gold stays above $4,500, this trend is incredibly bullish. Further down, watch $4,450 and $4,430, the launch pads for last night's V-shaped recovery. If gold pulls back there and holds, it could be a perfect last chance to get on the bus opportunity. Think of it like mountain climbing. We just secured a major base camp at 4,500. As long as we hold the camp and refuel, the next step is the summit. But if you see gold slip below 4,430, be careful. It could mean this was a fake out and the market needs more time to consolidate. After all those bullish reasons, I have to be the nagging one and mention the risks again. First, in this environment, never fight the trend. Don't fall into the trap of thinking, it's gone up so much, it has to fall. In a strong bull market, shorting is like standing in front of a freight train. It usually ends in disaster. We all saw what happened to that group of bears last night. Second, don't blindly FOMO with massive positions. Even if we're long-term bulls, we are at record highs. A massive pullback could happen at any time as people take their chips off the table. If you go all in at 4,500 and gold drops just $50, you might panic and sell at the absolute bottom. Third, keep your asset allocation smart. Gold is great, but put every cent you have into it. It's like dinner. Even a great steak needs side of potato salado be a complete meal. This gold rally is a reflection of a global shift and a lack of trust in fiat currency. It's a snapshot of a major new era. We're here to profit, but more importantly, to see the trend clearly and ignore the noise. It's like being at a wild party where the music is pumping and the energy is high. You just have to keep an eye on the exit and protect yourselves. You're the one who has the last laugh. All right, that's all for today's analysis. That was a ton of information to digest. We covered everything from the GDP battle to the durable goods warning. We looked at Trump's threat to Fed independence and the structural breakdown of the dollar. If you found this video helpful or if it gave you a clearer view of the gold market, please give me a like. It's the best way to support me in growing this channel. If you haven't joined the Gold TLD yet, hit that subscribe button and ring the bell. I'm the Gold TLDR. I'll see you in the next one. Bye-bye.